Greetings, everybody. This is Dan Gardner from Trade Facilitators Incorporated in Los Angeles, California. I'd like to welcome you to this, our seventh broadcast, free webinar that we've been doing since the coronavirus started. It's hard to believe it's April 29th. Hopefully May and June and the rest of the year will be better for all of us. In the meantime, I'm happy to see that lots of people are taking advantage of these broadcasts. Today is being entitled The Role of Sales and Operations Planning in a Global Import Model. If you attended last week's presentation, you'll see that it's very much a continuation of that theme, which was material requirements planning and purchase order management in a global import model. But what you'll also see is that we're going to expand that conversation, not just from the buy side of the supply chain, which is what MRP and PO management is all about, but also out to the distribution side, actually moving goods, finished product out into a distribution environment, and how sales and operations planning as a business discipline helps to link those two activities together. The buy side of a supply chain, the sell side of a supply chain. What we're going to be talking about applies to multiple business models. Could be a manufacturer who imports raw materials for production in the U.S. and distribution domestically and internationally. Could be an importer of finished goods. Any variety of models. As we often do, or almost always do, our example is going to focus around an importer of finished goods, but it is important to reiterate that what we're going to discuss, and we'll bring up other examples too, but what we're going to discuss is applicable to multiple business models. As is always the case with our broadcasts, you're welcome to a complimentary copy of the presentation. You simply write to the email address we provide at the end of the webinar, and we'll gladly send it out to you in PDF format. Also, on the housekeeping side of things, we have to have a muted mic. We have a lot of people online today, but you can write in your questions and we'll answer them as quickly as we can. And if you have questions or comments after the fact, which people oftentimes do, and I'll thank you for doing that, you can email them in afterwards. I've actually, as a side benefit of these free webinars we do, made a lot of new friends in the industry because people write and ask for copies of the presentation and offer commentary. It's been a good learning experience for me as well. So I hope we can continue to do that. With no further ado, we'll go through our disclaimer. This is the "we're not a lawyer" slide, so don't interpret anything we say as legal advice. Session agenda. As always, one slide intro to Trade Facilitators. I'm going to tell you a little bit about a certification program that Trade Facilitators actually produced. That whole drill will take 2 minutes or less. From there, we'll get into sales and operations planning, the definition thereof, S&OP for an importer of finished goods, once again stressing that the concepts we're talking about here apply to multiple business models. We already mentioned a manufacturer that brings in raw materials as an example for production in the U.S. And then is where we'll really start to expand the conversation, the relationship between sales and operations planning, material requirements planning, which we discussed last week, and distribution requirements planning, that overarching theme of bringing together, linking, aligning the buy side of the supply chain, how we acquire goods and turn around and resell them in a distribution environment. You will note as we go through this section that DRP, as it's called, distribution requirements planning, conceptually is very similar to material requirements planning. The conversation, when we get to it, is going to make assumptions about people's understanding of MRP, especially given the fact that we went through this last week. But we'll do our best to refresh people's memory as we go. Quick intro to TFI. That's the company I own and operate here in Los Angeles, Trade Facilitators, Inc. We're a consulting and training firm. You know that if you've been on these webinars before. We're right close, one town over from the Los Angeles, Long Beach port complex. I'm getting a note here saying we're experiencing difficulties with the audio conference. Audio will not be recorded during this time. Now it's saying connection lost. Can someone, this is a little alarming, Can someone type in or chat if they can hear me, please? Okay, sorry about that. Now the note is coming up saying the network connection has been reestablished. I got a couple notes from people saying I can hear you loud and clear, but that was from a moment ago. Can someone chat in or type in that you can hear me right now, please? Maybe Richard, who you had provided a comment, as well as Michelle. All right. Okay, good. Sorry about that. It just came up on the, you can't see my little panel on the side here, but it's a control panel for audio, webcam, when I choose to use that, et cetera. And it came up saying that the connection was lost. So that's a little alarming. Okay, let's get through this quickly. Trade facilitators, we lost a few minutes. So we're consultants and a training company. Do a lot of different things. Integrated logistics programs, CBP, partner government agency stuff, consulting for digital startups, and of course, training. Very quickly, wanted to make you aware of a certification that I actually produced a couple of years back for the National Customs Brokers and Forwarders Association of America. As the name would indicate, that's a nonprofit in DC that represents the brokerage and freight forwarders of America. I brought this back up because actually it was announced just the other day that the USMCA, US-Mexico-Canada Agreement, is officially going into effect on July 1st. And one of the modules in this program was on NAFTA. So I was recontracted by the NCBFAA to update NAFTA to USMCA, which is a production I'm going through right now. That's what made me think of it and bring it up. So what it is online, pre-recorded, fully animated, Zoom feature, arrows, highlights, the whole shooting match, 10 modules from the perspective of a U.S. exporter. This is a 60-hour program. If you're interested in certifications and you're looking for a check-the-box kind of rubber stamp type program to say that you participated in, this isn't for you. This is the real deal. And the Brokers and Forwarders Association insisted upon it being a real deal. So things like 5 or 6 hours on air freight, another 5 or 6 on ocean freight, domestic trucking, export compliance, that USMCA update, export documentation, EEI, the whole shooting match. Dozens of real-world examples. There's a quiz after each module and a cumulative final exam. As I said, these people aren't screwing around. If you're a member of the Brokers and Forwarders Association, it's $950, $1,450 for non-members. You don't have to be a member to participate in this. If you want more info, write to me and I'll tell you all about it because I'm the guy who produced it. Just double checking. Now that I'm paranoid about my sound, I'm double checking. All right, we're still good. I'm gonna just talk to myself for the next hour and see how that goes. Sales and operations planning defined. Let me begin by saying that for me, as a supply chain person who originally came from a logistics background, actually, this is one of the more fascinating yet most misunderstood and underused business discipline in all of supply chain. And sales and operations planning is definitely a business discipline where people have knowledge and they apply that knowledge to the benefit of the organization. What it really is, and we have a pretty detailed definition here, S&OP, as it's called, it's a perpetual, multifunctional business discipline that has a couple of goals associated with it to enhance alignment between the actual demand for a product and its supply. What we mean by perpetual, it's ongoing. It's not an event, it's a process whereby companies are constantly getting together internally with their vendors overseas, maybe even big customers, to look at a multifunctional viewpoint of the overall business, an ongoing exercise on an item-specific level. Starting with a sales forecast, as we'll see in a moment, which is a theme we've covered pretty extensively in prior webinars. Planning our year based on that forecast, whether we're a manufacturer or an importer of finished goods. And as the year unfolds, actual sales start to take place, we make a comparison between what we forecasted to happen, what's actually happening, and how do we react to that, or how do we respond to that. At its core, S&OP seeks out variances. That's essentially what I just talked about between forecasted and actual sales, and enables companies to make decisions on how to respond to those variances. As you'll recall from prior webinars, a variance is, for us in supply chain, it's just the difference between what we thought was going to happen, what we predicted was going to happen, and what really happened. That applies to forecasts, forecasting error to be specific. It applies to budgets, where the landed cost of a product that we estimated to be $8 actually came out to be $10. That would be a $2 variance there. Variance is the essence of supply chain, seeking out variation. Sales and operations planning as a discipline helps us to do that in a lot of different ways. Some other examples of variances or how to react to a variance, maybe we have a product that's selling better than we thought, and we need to produce, if we're a manufacturer, or import more raw materials to make more, or if we're importing finished goods from overseas, order more from our vendors. Maybe we want to make less. Maybe we want to cancel purchase orders. It all depends on item-specific performance during the course of a budget year. It is very important to point out that sales and operations planning also sensitizes people's focus on the financial impact of go-forward decisions. It might be great to have a product that's selling well and we want to manufacture more, but what happens if there's just a financial constraint, a reality that we don't have the cash flow to go out and buy more raw materials? Sales and operations planning, when conducted correctly, will reveal those constraints in a supply chain. We'll see more examples of that as we proceed. Alrighty. This is a slide that we showed previously and want to share again. When we showed it last week, it was within that context of material requirements planning, the acquisition of finished goods from vendors overseas. It has an application for sales and operations planning as well. In fact, it's almost nearly 95%, 98% verbatim of what we showed before. The theme being the alignment of supply with demand signals. You'll recall from our example, or I'll state it now as well if you weren't tuned in last week, we have a company in our particular example, fashion company that sells through their retail stores, catalog, as well as web sales. Prior to the beginning of a calendar year, a fiscal year, that company is going to prepare a sales forecast. Based on that sales forecast, purchase orders have to be placed on vendors overseas. As the year unfolds and actual demand signals start to come in, what do we mean by that? People go into stores and buy stuff. They go online. They buy through a catalog. So what happens is, over here, this is the implication for sales and operations planning. As actual sales takes place, These demand signals must consume the forecast. That's a term we've used before. Consuming the forecast means taking actual sales for January or February, March for the whole quarter, comparing it to a forecast, compare your actual to forecasted sales, and hopefully you sold more than you forecasted. Obviously not always the case, but whatever that number is that we sold, that's the amount that consumes the forecast. Any difference between the two, plus or minus, is that variance that we spoke of a moment ago. Why do we bring this up? Well, based on S&OP activities and what it actually entails, which we'll explain in just a few moments, based on the results of S&OP activities, updated demand info then cascades up the supply chain, the conversion of demand signal to purchase orders. Once again, this is an example of a finished goods importer, but the same could apply to an importer of raw materials that manufactures in the United States for domestic distribution as well as international distribution. It's just a question of how the business model is structured. Of course, the manufacturer isn't placing purchase orders on overseas vendors for finished goods. They're placing purchase orders on overseas vendors for what? Raw materials that are based on what? A master production schedule that is driven by what? Material requirements planning that we spoke of last week. The point of this slide is we want to use S&OP to enhance this activity regardless of our business model. Let's continue on. I'm just continuing on with my paranoia and making sure that I'm not really talking to myself here. We're good. Sales and operation planning. Very, very critical point to make. I mentioned it a moment ago. Focuses on the financial performance of specific items. Selling lots of an item is one thing. Making money at it is another. Sales and operations planning forces us to engage with our colleagues from accounting and finance to determine item-specific gross margin and gross profit. Maybe a gross margin of 50% per unit sold and a gross profit of $20 per unit sold. It's important to point out that gross margin, and this is just a pet peeve of mine from my days as an accounting student, gross margin always expressed as a percentage. Gross profit always expressed as a dollar figure, just to make that distinction. What we want to say with this first bullet point, S&OP just isn't about comparing what we thought was going to happen with what really happened and then just making adjustments. There is a considerable financial sensitivity to all of these activities. Another benefit of S&OP is that it should lead to the identification of constraints or excess capacity in a supply chain. I made reference to one constraint just a moment ago. A company who manufactures their own merchandise is doing well on a particular item. They want to make more, but they just don't have the money, the liquidity, the working capital to acquire more raw materials or access to credit markets to get a loan to go out and buy those raw materials. Or maybe they have access to the credit markets, but they don't like the interest rate that they're going to have to pay. And the margin on making more of that product is too low to go forward with. Those are the types of things that sales and operations planning should tell us. A couple of examples. A manufacturer wants to produce more of an item but doesn't have the production capacity. Our example was about having access to working capital to go out and get raw materials. Here's another. A manufacturer in the U.S. is doing well on a couple of items, maybe related to, unfortunately, COVID-19. They want to make more, but they don't have the production capacity. They only have 5 lines. They can only make so many rubber gloves in a month. S&OP should reveal that. Another example, an importer that wants to order more of an item. They're not making things themselves, so they can't check with their manufacturing people. Who do they check with? Their vendor overseas to see if they have the capacity. Or enough lead time, what's referred to as cumulative lead time, to get the stuff in. Because if a company, especially in the fashion business, like in our example, is doing well on a product, and there are different seasons, There are different collections, fashion collections and such, different fashion trends that begin and end very quickly. This becomes a big deal, cumulative lead time, meaning a product might be doing well today, but it's springtime. If I can't get more of that product for 120 days, the party could be over on that product. S&OP should reveal those kinds of things also. Here's an old school slide. Sales and operations planning, aligning functional areas that have conflicting goals. Yet another benefit of sales and operations planning, definitely internally in an organization, is that it points out that although we work for the same company, depending on what area we work in, we could have a goal that is in conflict with another department's goal. This is where trade-offs come into play and compromise comes into play, all data-based decision making. A couple of examples here. There are many more, but for time purposes, we wanted to limit it to 4 examples. Here's our product offering. Maybe we sell 5,000 different products or 5,000 different items, but 25,000 different SKUs, different types of packaging, configuration, number of items in a package, etc. You could have 5,000 items and 25,000 SKUs. Our product offering. Let's start over here with sales. The people that are out selling this product in the marketplace. And for purposes of this discussion, let's switch things up for a minute to give equal billing to a company that manufactures their own goods and imports raw materials from overseas. Sales, what do they want? Availability of the product in any quantity, multiple variety, every SKU you can possibly imagine. To do what? Satisfy the needs of the customer. That implies big time investments in inventory, all different types of packaging requirements, and a wide variety of products. Maybe not 5,000 items with 25,000 SKUs, but 15,000 or even more items with hundreds of thousands of SKUs. Sales is out there to satisfy the needs of the customer. But if you transition into a production environment, our own internal production, what do manufacturing people want to do? They want to have large lot sizes. They want to make a lot of the same stuff over and over again to achieve things like economies of scale, to maximize the capacity of their production equipment. They want to avoid frequent setups, meaning when different products are manufactured on the same line, that line has to be converted. Maybe a new die has to be put into place. Maybe if it's in the chemical or paint business, we have to clean out all the paint and the color that was being made prior to that. That's called a setup. When you're setting up, the machine, the line isn't running. And when the line isn't running, our economies of scale suffer. Production doesn't want wide variety. They want large lots with infrequent setups, and of course, that less variety. Purchasing, in our instance, these are the people that have to go out and get the raw materials, buy the raw materials from overseas vendors. They want to make big-time purchases to achieve their quantity discounts. And perhaps work with multiple suppliers, or in today's day and age, especially if a company is sourcing raw materials in China, we all know how that's gone in certain industries. Maybe they're looking to change suppliers to another country. And that other country has a different duty rate for the importation of the same raw material that was previously sourced in China. That can definitely happen. Up or down, favorable or unfavorable. It's not just a question of how many suppliers we work with, but where they are as well, especially in an international environment. And then, of course, the finance people, the realists in the group, they want low cost, low unit cost, which is actually in unison with production on the large lot size. They also want higher revenues, but the salespeople are going to say, well, if we don't have total availability in any quantity in a wide variety, how are we supposed to maximize revenues? There's a conflict there. ROA stands for return on assets, like things like production equipment. And here's the last piece, strong cash flow. Sales and operations planning should help to, at the very least, uncover some of these conflicting goals and help people based on actual data that sales and operations planning can generate to reach consensus, to reach compromise, to ultimately create a balance between the needs of the client and the financial needs of the organization. Continuing on, I was just checking for questions. I think we're okay. What else does sales and operation planning do? What if simulations? Now we're starting to talk about, and perhaps I should have mentioned this earlier, the need for sales and operations specific software, either part of a bigger enterprise resource planning module or standalone software. And there's lots of companies out there that provide these capabilities. In a general sense, to conduct sales and operations planning activities in a manual format, spreadsheets and emails and all that good stuff, it can be done, but as you might imagine, a little bit on the cumbersome side. There are full-blown, very capable software modules out there that allow for this. And one of the things that they allow for is a what-if simulation. What if we decide to alter manufacturing levels for a given product? What does that do to our budget? What does that do to landed cost? How does it impact margins, inventory levels? That what-if capability is what uncovers sometimes these conflicting goals between the various departments. Second bullet point, an important theme as we move forward in this presentation, is that S&OP serves as a key link between material requirements planning and distribution requirements planning, which are business disciplines in and of themselves that we'll talk about more in just a moment, that really work towards matching supply to demand in the right quantities, at the right location, and I should have added here parenthetically, at the right time. If you're familiar with MRP, if you were tuning in last week, we talked about things like gross to net exploding and lead time offsetting. For now, we'll say that those concepts, born in an MRP environment, are equally applicable in a DRP environment. More on that in just a second. But the whole drill is about using S&OP to make determinations, future but immediate determinations about quantities of product, where they need to be in the distribution network, at what time throughout the year do they need to be there, and what's it going to cost us. In that context, one can see how sales and operations planning really does bridge the gap between MRP and DRP, whether we're a manufacturer or an importer of finished goods. Last thing on this slide, ultimately, in the spirit of continuous learning, S&OP should enhance forecast accuracy, especially for products that we sell throughout the year over an extended period of time. In the fashion world, what's referred to as basics, your jeans, your cotton t-shirts, your beach sandals. It's a little different when you're dealing with a new product introduction, admittedly, because it's a new product and it's hard enough to predict the future for an existing product, never mind a new one. But over time, S&OP, if we're learning from what we've observed in the past, should enhance, not make perfect, but enhance forecast accuracy. The application of past learnings to future outcomes. It's never going to be perfect, ever, 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 but it might help us be a little bit better. All right, let's get a little more visual here. You'll probably recognize this slide, and this is intentional because I like to use the same slides and talk about a lot of the same stuff because it creates familiarity. It creates a comfort level when people recognize what they're looking at, especially if you have the opportunity to be on other webinars or listen to the recordings of other webinars. This is a basic slide that is intended to illustrate the need to align actual demand, not just a forecast, but actual demand signals in stores, online, through the catalog, etc., with sources of supply. I use this slide a lot in my classes that I teach as an adjunct professor, especially because many of the people in those classes are just starting out in supply chain. And this is simplistic enough to get the concepts across, but it can be taken to a more detailed level, as we'll see in subsequent slides, to really drive home some pretty important concepts. What we're looking at here are different types of inventory that acknowledges S&OP is applicable to different types of business models. Those raw materials that we have to bring in to engage in production in the U.S., maybe sub-assemblies, the work in process that we deal with as manufacturers. Finished goods, if we're an importer of finished goods, this applies as well, any accessory service parts, etc. The key point here, and we'll see this slide a couple of times with increasingly amounts of detail attached to it, but for now, we're looking at the buy side of the supply chain and the sell side, whether we're a manufacturer or an importer of finished goods. Materials management, that's that MRP side of things, material requirements planning. Distribution management, more associated with the sell side of a supply chain in a finished goods environment, all of which is driven by customers. The idea being that we start to see demand signals as the year unfolds from these customers, from store purchases, from catalog sales, from online sales, or however it is we sell to customers. And that information has to find its way up the supply chain to make adjustments in a manufacturing environment, whether we do our own manufacturing or we outsource that manufacturing. One of the things that I emphasize is the decoupling of the supply chain from a buy side and a sell side perspective, but then how do we bring it back together? Because if we treat these as two different things, two different worlds, two different universes, we're never going to achieve the benefits that S&OP has to offer. Once again, we'll see this slide in upcoming discussions with more detail associated with it. Wrap up a couple of things on S&OP. We've already said this, let's make it a formal declaration. By definition, we need multiple departments involved in the sales and operations planning process, starting with demand planning. What are some of the subsets of demand planning? Forecasting, number one. Order management, number two. Actually receiving orders from customers. Calculating what inventory we have in the pipeline that is available to promise. These are all demand management functions. Of course, sales, sourcing and purchasing, these are the people that go out and get the stuff that we need. Manufacturing, most definitely, if we do our own manufacturing. Accounting and finance for certain, because they're the ones that are going to tell us what are the financial results of all these earth-moving efforts that we're engaged in across our global supply chain. And IT as an enabler from a visibility and execution and measurement perspective as part of the whole drill. I'll say it again, since IT came up here. Ideally, S&OP is enabled by software, either as part of a much larger enterprise resource planning software package or standalone S&OP, which they are out there. As we said also, it's applicable to most any business model, whether you're a manufacturer, wholesaler, distributor, finished goods, etc. And that business model, meaning what it is you do. Are you a manufacturer? Are you a wholesaler? That will determine your business model. There's a big difference, as an example, between S&OP for manufacturer versus a company that outsources their production. The biggest obvious difference being that the manufacturer, they're not just placing purchase orders on a footwear vendor in Vietnam. They're creating a forecast. Based on that forecast, a master production schedule. They use MRP logic to determine what raw materials they need in what quantities at what time throughout the year. How that gets converted into finished goods out into a distribution environment. It's a big difference between a manufacturer and a company that outsources their production and is placing purchase orders on a vendor overseas for those actual finished goods. This is a slide that I'm especially attached to. And what you see here, it was actually the theme of the first book I ever wrote. Came out in April of 2005. Oh boy, I hate to think. 2004, I want to say. It's been out 16 years, so do the math. Yeah, 2004. It was called Supply Chain Vector. And it was all about the relationship between supply chain execution and financial results. And the research that I did at that time has really molded my philosophy. And even though I'm a non-financial executive, I don't have a degree in accounting, I have an orientation, a sensitivity towards the financial impact of our supply chain activities, and so should anyone else, whether you work in manufacturing, sales, marketing, IT, it doesn't matter. What this slide does is to demonstrate, at least visually, how S&OP can help balance supply with demand and financial expectations. You look over here. Sales and profits, obviously a big goal of any organization, but there has to be a balance between how much we sell and how much we make as a profit and how much we have to invest in inventory. If we suck up all of our liquidity, all of our working capital, creating that endless array of products that sales requires, it's going to eventually have an impact on our sales and profits. Maybe we overbuy. Maybe we get extended. Maybe it impacts our liquidity. Sales is one thing. Profits is a big thing. What we have to invest in inventory to pull it off, or what we're capable of investing in inventory due to financial constraints, this is the balance that we're looking for. S&OP, it's not a panacea for any imbalances between the two, but certainly heightens the sensitivity that people have because it orients our thinking. S&OP, when executed properly, forces us to think this way. Yeah, we can sell a ton of this stuff, or our sales went up 20% in the first quarter, but our investment in inventory went up 50%, and we don't have any money, and we can't meet payroll. That happens a lot in business today. S&OP helps us to avoid that. The relationship, and this was the theme of that first book of mine, Supply Chain Vector, the relationship between sales and profit and inventory investment and how it trickles into the financial statements of an organization is demonstrated here. And as I said a moment ago, it doesn't matter that you're not a financially oriented person or executive. You have to be aware of these things and understand the relationship between three very important reports: the income statement, the balance sheet, and the cash flow statement. But the main component of a cash flow statement, there's three parts to it. The one we're most interested in is cash flow from operating activities. What are those links? Your sales and your profits show up on the income statement. We registered X amount of sales. We had a certain amount of cost of goods sold. That takes us to gross profit, to be expressed as a percentage in gross margin. All very important. All of that, all of our sales, all of our expenses show up on the income statement, all the way down to net income. Very nice. However, taking us back to the theme of the inventory investment, how much do we have to invest in inventory to pull that off? Inventory values always, always, always appear as a current asset on the balance sheet. I'm a big fan of cash flow from operating activities because it provides a comparison between what we did over here and what we had to do over here. At a bare minimum, you don't have to be a CPA. You don't have to have a degree in accounting. But as a supply chain professional, you should have an understanding about the need for balance between sales, profits, and inventory investment, and where those outcomes are expressed in financial statements. That's why this slide, while simplistic, is pretty important. Check something here. We're all good. Okay. Let's have a look at sales and operations planning, going back to our original example of an importer of finished goods. You'll note that this slide has a portion in green, as well as a subsequent slide, a portion in red. That recognizes that by definition, an importer of finished goods is outsourcing manufacturing. And as such, they're outsourcing master production scheduling, MRP, material requirements planning for raw materials, capacity planning for the lines. Obviously, the supplier overseas is doing all of those things. But one of the biggest mistakes that companies made when outsourcing really kicked in, going back to the early 90s, is they undertook the attitude, well, I'm outsourcing manufacturing. I don't have to worry about any of that stuff anymore. Big mistake. That's where the decoupling of supply chains began. Because when you decouple things like sales, demand management, accounting, and finance from production because it's being done by somebody else, that's very, very harmful to a supply chain. The message here, as an outsourcer of production of finished goods, we cannot decouple the two just because someone else is doing the production. You could make the argument, empirically proven argument, that the communication has to be even greater with a third party as opposed to our own manufacturing people. More on that as we proceed. For now, for an importer making purchases of finished goods from overseas suppliers, several functional areas involved in the SOP process have to be present. In green, these are our people. We are that importer of wearing apparel, footwear, accessories, etc., that we're planning on placing purchase orders for finished goods on vendors overseas. We do that. The budget year kicks off in January. We start seeing actual sales. S&OP, in a continuous process, is constantly looking at item-specific performance against what was forecasted for and what adjustments need to be made. In order to do that, who do we need present in these monthly or even weekly meetings? Sales, for sure. Demand management, as we just defined a moment ago. They're in charge of things like the forecast and order management and available to promise. Sourcing and purchasing, these are the people that are finding the vendors and then placing the orders, purchase orders on those vendors. Inbound shipping, logistics, and customs compliance. That's a big tie-in to cumulative lead time. We're going to have a production time that we have to gauge with our vendors overseas, but also how long does it take to get the stuff in from Malaysia or Vietnam or Australia. Distribution requirements planning, which we have 4 or 5 slides on coming towards the end of the presentation. That's a finished goods environment, what products we need where in our distribution chain, at what time and in what quantities, and accounting and finance. S&OP is all about the money at the end of the day. In general, business, you want to be a good corporate citizen and all that good stuff, but in the end, it's all about the money. Accounting and finance has to be present. This is that same slide we talked about. This time, sales operations planning, importer of finished goods, to illustrate a point that I made previously. And that is that, yeah, we're going to have a buy side of the supply chain. We're going to have a sell side of the supply chain. But the possibility, because we outsource production, to decouple one from the other, and that's not intentional, it's just a natural human consequence, is high. When we outsource our production to a manufacturer overseas, the entire discipline, known as manufacturing planning and control, MP&C, is outsourced to that supplier. So based on whatever it is we're telling them as the importer of finished goods in the form of purchase orders, is going to instruct this manufacturer, who probably manufactures on a build-to-order basis only, how to proceed. What we tell them, whether we're sharing forecast information for the year, placing those purchase orders and making adjustments to them throughout the year, is going to inform this manufacturer about their own master production schedule, their own MRP activities, capacity planning in their plant, what type of raw materials and in what quantities and at what times of the year do they have to go out and get those raw materials from suppliers. In the end, in terms of functions, outsourcing of manufacturing versus in-house manufacturing, it's the same thing. It's just a question of who does it. And what we're saying here, for purposes of sales and operations planning, we can't lose sight of the fact that our communication might be degraded because we're outsourcing our manufacturing. Super, super important. Don't make the mistake that companies made some 20, 25 years ago that said, oh, we don't make anything anymore. We don't have to worry about any of that stuff. Master production scheduling, MRP, capacity planning, that's all on the vendor. And that's true. But if we're not communicating with that vendor, just like we would if we were a manufacturer ourselves with our own manufacturing people, the link between the buy side and the sell side is going to be diminished considerably. Just checking on questions. I think we're okay. And hopefully you've been hearing me for the last half an hour, because that would be a real drag. On the other hand, for an importer making purchases of finished goods from overseas suppliers, we have to engage with our suppliers because they're doing all the things we just talked about. They're the ones doing their own master production scheduling, bearing in mind that we're not their only customer. They're doing MPS for a variety of orders from a variety of different clients in the United States, in Europe, etc. They're doing MRP for raw materials, capacity planning for the actual lines that they have, outbound shipping, and their own accounting, because contrary to popular belief, they're out to make a profit too. Here's another portrayal from that perspective of the U.S. importer of finished goods, the integration and synchronization of multiple functional activities. This is us over here, that U.S. importer wearing apparel, footwear, accessories. These are our vendors overseas. By the way, depending on the size of our company as the U.S. importer, we could work with 200 active suppliers easily. I've seen that repeatedly. Couple hundred, 100, couple hundred, no problem at all. We have to engage in these activities with every single one. We're the ones doing the forecast and measuring actual demand. We're the ones out looking for vendors, placing purchase orders on those vendors, and paying attention to inbound shipping and the cumulative lead time associated with that. The overseas supplier, order management to them is receiving a purchase order from us. For them, it's a sales order. They have to do the master production scheduling, which drives material requirements planning, go through production into outbound shipping. Pulling that off for a global enterprise with a couple hundred vendors around the world in an omni-channel environment where we sell 3 product families, wearing apparel, footwear, accessories, in our own stores, online, and through catalogs, that's complicated. Sales and operations planning will help to make it less complicated. Quick summary. This was a definition that I worked up for a client back in July of 2000, almost 2 years ago. Holy smokes. And anyway, in any event, we'll run through it fairly quickly because it's a good, at least I think, biased obviously, a good summary. S&OP, it's a multi-departmental business discipline. We already said that allows companies to synchronize product supply with demand. It's a permanent activity, at the very least, monthly meetings, if not daily discussions with our colleagues in various departments. S&OP uses updated forecasts to convert high-level supply chain strategies into operational activities that include what? Master production scheduling, materials planning, capacity planning, inventory management, purchasing order management, logistics, and accounting. If we are the manufacturer bringing in raw materials from overseas for production here in the U.S., we're doing all this stuff, certainly up to capacity planning and inventory management, as well as all these other things. If we outsource, we spoke of this in some detail, these activities are undertaken by our vendor. Do not decouple, either philosophically or operationally, the buy side of the supply chain from the sell side of the supply chain just because we outsourced our manufacturing. In the end, sales and operation planning forces executives to constantly compare daily, weekly, monthly, quarterly, period-specific forecasts with actual sales, actual demand signals, and then make adjustments that reflect any variation. There's that word again, my favorite word in all of supply chain, variation, and the search for it. Whereas the specifics, we said this already, of the model of the function may vary by industry and company, manufacturer versus an importer of finished goods. S&OP is essential to making sure that an organization does what? A balance between demand, inventories, and profitability. That profitability theme coming in at the end. All right. We have 11 minutes. This presentation slide-wise is a little shorter than what we've seen in the past. So we should be, I always say this for the people that are online. Just checking something on the technology side of things. But I always say, I think we're in good shape. And then I go 10 minutes over. because we had that delay, I'd like to technically think that you guys owe me 5 minutes, but that would be a bit of a presumptuous move on my part. I hope you can stick around because we're bringing it all together. What I'm trying to say is we don't have that many slides left. Certainly fewer than what we've had in previous presentations. Here's that third slide again. Now we're talking about linking materials planning over here, the acquisition of raw materials if we're a manufacturer, or finished goods if we're an importer, on the buy side of the supply chain, and getting those goods out in specific quantities, in specific locations, at specific times during the year to meet what? Customer demand. That's DRP. MRP and DRP conceptually, very, very similar. Our demand signals feed in through the year. That information finds its way up the supply chain to the manufacturer, whether it's us or an outsourced vendor overseas. They're working with their own raw material suppliers, tier 1, tier 2, tier 3, go into production, back out, taking into consideration the cumulative lead time that it takes to receive a purchase order, make the stuff and ship it and get it out into the network and satisfy those customer needs. Those red arrows make it look pretty easy, don't they? Everybody knows just how difficult this is. So we certainly don't want to minimize how difficult this is with an oversimplified slide, but it once again drives home that point about the coupling of the buy side and the sell side of the supply chain and how S&OP facilitates that process. All right, let's talk about DRP, mainly because we talked about MRP last week and we need a whole other hour to go through that. Conceptually, whether it's MRP or DRP, and I'm jumping a little bit ahead here, it's all about making determinations based on a forecast and then actual demand signals about what items are needed in what quantities, where they're needed in the supply chain, and at what time during the year, and then finally, what's it going to cost us to pull it off? In that sense, MRP and DRP are the same. Distribution requirements planning. It's math-based, just like MRP. It's a supply chain technique, discipline, that determines the quantities of finished goods that need to be in specific locations in a distribution network, i.e. finished goods, at specific times. Just like we see in MRP, it's a time-phased approach, meaning weeks in a year, that are referred to as a time bucket. These are actual terms from APIC, the American Production and Inventory Control Society. Time bucket is typically a 1-week period, so there's going to be 52 time buckets throughout the year. Based on that, the logic is very similar, as we said, to that of MRP. I think we do have a question here. Oh, hold on. What are some of the factors that create dysfunction or alignment between sales and production? Can you drill down the importance of incentive planning for sales in regards to alignment with production? Oh boy, how much time do we have left? That's a very good question that has a lot of different explanations. Some of the factors that create dysfunction or alignment between sales and production. Here's one, and it's more psychological than anything. Salespeople, by definition, are optimists. They always think they're going to sell more than they will. The input that they have, albeit from a qualitative perspective to a forecast, might be a reflection of that overly optimistic view of the world. Another thing that impacts the relationship between sales and production is take a product that's sold year-round, a basic, that was discounted last year because of overbuys and inventory, that makes it look like sales were actually higher when the only reason why we sold the stuff was because we had to sell them for $10 a pair instead of the usual $50 that we retail sell for. That's a signal that isn't necessarily a reflection of actual demand, which ties back to the financial performance. If we're selling at $20 a pair and achieve that high level of sales, were we actually making any money? What if our landed cost was $25 a pair? That's just another example. All right, let's move on. What does DRP do? It helps supply chain professionals to answer a series of very important questions. obvious to many, but the more obvious things are in supply chain, my experience has been the more difficult they are to actually execute upon. I've said this before. There's an inverse relationship between stating the obvious and how easy it is to do. Very difficult. What items will we need out of 5,000 items that we sell? How much of each are we going to need? Not just at one moment in time, but throughout the year, taking into consideration seasonality and sales and discounted pricing, etc. In what location, at a distribution center or a forward fulfillment position, will they be needed? When do the needed items have to be in-house? And will we have any item-specific inventory on hand already that would cause us to provide a net amount as opposed to a gross amount? That's that gross to net exploding conversation we had last week. More on that in just a second. A shorter definition is that DRP logic, what's it do? It calculates item level, time phase requirements, week 1 through 52, in specific quantities. Just like we said S&OP is enabled by software, so is DRP as part of a larger enterprise resource planning suite of tools or standalone DRP software. Either way, manual or digitized, that's over a planning horizon, which is typically a year, but it could be quarterly or monthly, and by time buckets, 1 through 52 for the year. Important to point out, while recognizing different uses of terminology and semantics, etc., DRP, technically, distribution, is intended for independent demand items, also known as finished goods. DRP, as a function, is heavily influenced by actual demand consumption signals, usage in the field, people going into stores, buying online, etc. And as I said a moment ago, the good news is that these days, DRP operations are fully automated by software applications. In fact, you can get S&OP modules that address DRP requirements. Functional integration, if you will. All right. A further explanation of DRP. And we're almost, give me 5 minutes overtime, please. We're going to pull this story together. As is the case with MRP, distribution requirements planning starts out by calculating gross requirements by time bucket based on a forecast. A gross requirement, starting with a forecast, says if we have a fulfillment center, we have a DC in Mechanicsburg, PA, and a fulfillment center for the northern part of the northeastern United States in Portsmouth, New Hampshire. DRP is going to tell us, based on a couple of different factors, cumulative lead time not being the least, how much we're going to need in that fulfillment center throughout the year. That's a gross requirement. The forecast says we're going to need 1,000 of these in that fulfillment center in Portsmouth, New Hampshire. What if we're already planning to have 200 in that fulfillment center in inventory? That would mean that our net requirement would be 800, very similar to MRP as we spoke of previously. Continuing on that thought, that gross requirement has to be netted out to reach the net requirement. And this is quantities across the network. How much do we need in the DC in Mechanicsburg, PA? How much do we need in each of the fulfillment centers on the eastern seaboard, down to the mid-Atlantic, from Portland, Maine, down to Virginia, let's say? That's what DRP will tell us. First, based on a forecast, and then adjustments made based on actual sales. Combination of DRP capabilities with sales and operations planning sensitizes the accuracy of that information. Some things to take into consideration when getting down to a net requirement. What's our on-hand inventory? That was the example I gave a moment ago, where DRP software is telling us we're going to need 1,000 items of 1,000 of a specific item in Portsmouth, New Hampshire, but the system is also telling us we're going to have 200 on hand. That net requirement comes down to 800, as we said. Maybe there's replenishment, or what are referred to as transfer orders from the DC in Pennsylvania already in place. We have to account for those. If there's a backlog of transport orders. We have to account for that. Plus those inter-network supply orders, essentially the same thing. Lead time offsetting, also applied. We talked a lot about this in previous webinars, where we have to calculate how much time is required from the moment we replace a replenishment order until we get that replenishment order. Now, maybe for us, if we're running that fulfillment center in Portsmouth, New Hampshire, we're only worried about the transit time from Mechanicsburg, the big DC, and Mechanicsburg, PA to us. And that's a reasonable thing to say. However, that worry extends itself all the way up the supply chain to either a manufacturing site or a vendor overseas to determine how long all that is going to take too. How long is it going to take to get all that stuff from a vendor in Malaysia? That's called cumulative lead time. We have to employ that as well. Ideally, done in real time, DRP data must find its way into the buy side of the supply chain. That's essentially what we just said. Here's a visual portrayal. You'll recognize this if you were on previously. This is back to our example for DRP for an importer of finished goods, and we're almost, actually 2 slides to go. And it's 11:31, so not too bad. Please stick around. This is for our online and retail store operation, where the demand signals are registered, and putting ourselves in a position, especially as it relates to regional DCs, maybe ones in Mechanicsburg, PA, maybe a local fulfillment center in Portsmouth, New Hampshire. But how long is it not only going to take, based on actual demand signals, to replenish stores, to replenish the fulfillment centers for online orders, not just here, but all the way back to overseas suppliers, where knowledge of both individual leg, international transport versus domestic transport, and cumulative lead time is essential to DRP. Let's summarize. Everything starts with forecasted amounts needed for online sales and in-stores on a specific date. That's a gross requirement. We need 1,000 of item 1, 2, 3, 4 in the Portsmouth, New Hampshire fulfillment center in week 40. Based on the forecasted amount for each product, DRP software generates info on how much is needed in each store and online fulfillment location and when, all the way up the supply chain. Actual replenishment amounts that are ordered must consider inventory that will already be in the store, as well as replenishment orders that have been placed. That's the net requirement. That 1,000 gross requirement netted down to 800 based on the fact that we're planning on having 200 units on hand, and I think I said week 40. Replenishment orders must be placed based on cumulative lead time, using this concept of lead time offsetting that we discussed previously. And then, based on all the above, DRP software generates item-specific information on what needs to be ordered and what quantities and on what date. The tie-in, hopefully you can see, between sales and operations planning, especially the financial implications of all this, are a great enabler, mutual enabler, between sales and operations planning and distribution requirements planning. Last slide, and thank you for sticking around. Let's see if we have any other questions before we do that. We're all good. Last slide. Quick summary on S&OP. Hopefully you can see just how important this is. To be successful, it must be viewed as a permanent, ongoing business discipline. It should be technology enabled, ideally. It's a multifunctional undertaking: accounting, finance, demand planning, sales, marketing, production, purchasing, IT, etc. Bearing in mind that item-specific sales and operations planning focuses on a number of areas, variances between forecasted and actual sales for sure, the uncovering of supply chain constraints, be they in production, lead time, budget, etc. And that emphasis on financial impact of your S&OP decisions. Does it make financial sense to do X? Does it make financial sense to do Y? And ultimately, over time, sales and operations planning will serve as a launch pad for continuous supply chain improvement. Why is that? Because you're learning so much going through this ongoing exercise, uncovering opportunities, uncovering constraints, learning things from customers, learning things from our salespeople. If we take all of this information and we don't put it to use, not only on the short term, but on the long-term perspective of continuous improvement, we're losing out on what sales and operations planning can really do. All right, that's that. So thank you very much. Stay safe and healthy. We're going to do an encore performance next week of a webinar we did, I want to say 3-4 weeks ago. And the reason for that is, as I mentioned at the top end of the webinar, is that the USMCA, the US-Mexico-Canada agreement, the free trade agreement that replaced NAFTA, it was made public that it goes into effect July 1st. I was speculating when we did that previous webinar, because it hadn't come out yet, the date hadn't come out yet, I was saying, based on what was in the agreement itself, June 1st. But it's actually July 1. So people need to tune in. Whether you're an exporter to Canada, importer from Mexico, or vice versa, we're going to do an encore performance. Sourcing in Mexico, the USMCA tactics and best practices. If you want a copy of this presentation, write to me at this email. If you'd like to learn more about that Master Export Specialist certification that I produced for the Customs Brokers and Forwarders Association, write to me at this email. If you'd like to talk more about sales and operations planning or any of the services that TFI offers, there's a pattern forming here. Write to me at this email or call us on the phone. With that, when we reconvene, it will already be May. So hard to believe. But stay safe, stay healthy. Hope you can tune in. Hope you got something out of this webinar, because sales and operations planning is a big deal for global supply chain professionals. We shall see you next week, if not sooner. Thank you very much. Stay safe. Hello.